If you have been watching my videos, you would see that whenever I analyze a trade, I'm analyzing that trade based on real-time price action. That means my analysis is based on what price is doing at the moment and what price is going to do next. But in today's video, I'm going to be showing you how I backtest a trade. And I always use the 15 minutes and the 5 minutes to confirm this particular backtesting. Before going to the video, if you're seeing me for the very first time, my name is Divine. I'm a forex trader, and what I basically do on this channel is document how I trade and as well make videos that will improve your trading. If you want to be seeing content like this, I want you to smash the subscribe button, like this video, and drop a comment. I'll be right back. The first thing I want you to understand is that for every move that you see on the chart, it is being powered by a point of interest. Now, if price is going to the upside, it is simply powered by a demand point of interest. And if price is going to the downside, it is being powered by a supply point of interest. That's the first you want to understand. Second thing you want to understand is that for that point of interest to be powered, there has to be liquidity that will help the point of interest to be powered. What this means is that when I want to backtest or when I'm taking a trade, my focus is simply on the point of interest and on the liquidity that will power that point of interest. I'll give you an example on USDCHF. I took this trade and I'm going to maybe backtest it for you to see how I often backtest. Remember, my focus is simply to identify a valid point of interest. And for me to identify a valid point of interest, it has to be on the 1 hour time frame. Let me go to the 1 hour time frame and show you my point of interest. Now, if you look closely, this is my demand point of interest, right? This is my demand point of interest. The first thing I'm looking for. Second thing I'm looking for is to see if there's any liquidity that will power the point of interest. And as you can see, there's liquidity here that will power the point of interest. And as price looked at liquidity and came into my point of interest, I'll look for a change of character. And that happens on the 15 minutes time frame. Let me show you. Now, on the 15 minutes time frame, price gave me a change of character when price took out this particular high that was here. And as you can see, this high was taken out by this low. So this place becomes my strong low, right? And when price took out this particular high, price simply moved to the upside and gave us this high here. So basically, this is the high and this is the low. Now, in between this high and this low, I want to identify my point of entry. And the best point of entry is for price to take out liquidity. And you already know how liquidity works. That price will make a fake move for price to make an actual move. In this case here was my liquidity point. That I want price to simply sell down to this point, and I'll look for a buy opportunity. That is the fake sell move that will trigger a buy move. Now, price came into my point of entry. I simply took a buy from this particular entry point, but price stopped me out, and I had a loss of I don't know, 15 or $20. I can't remember. I took the loss, but it's still fine, right? That so long price meets your plans, you're good to go. In this case here, I wasn't expecting price to come this low because I was assuming this place was strong low and this was a weak high. But as you can see, price took out the low and I had a loss. Now, the next thing I had to do was simply for another entry. right? That's because price took out this particular low, I'm expecting that price is going to go lower. And where is the high that caused this low to be taken out? It's simply this point here. That means here becomes the new high and here becomes the new low. And I'm expecting here to be a strong high and here a weak low. Hence the reason for my sell entry at this point here. The same principle of liquidity, that price will always induce liquidity and price will make a fake move for price to make an actual move. I was expecting here to be the fake move that will trigger the real move for a sell. Hence the reason for my entry at this point here, that this liquidity point is simply going to trigger a sell to the downside. And this trade happened on Friday. Because I knew it was Friday, I didn't hold this trade for long. I only used this trade to recover from my loss here. And I closed at a 1:2 risk to reward, which was like, I don't know, $20 or so, just to recover from my loss here. Right? So this is basically how I backtest my strategy. That I'm focused on two things. Where is the valid point of interest? And where is the liquidity that will power the point of interest? Now let's look at the last trade I analyzed in my last video, GBUSD. Now if you look at this trade, I missed this trade from this point. I missed the trade. The same principle, the same concept. I'm not worried about the outcome. I'm only worried about properly identifying the patterns that will give me the outcome, whether it's a win or a loss. I always used to say, or I always use an analogy of 1 + 1 is equal to 2 or 1. In real life, 1 + 1 is 2, but in marriage, 1 + 1 is simply 1. I always use this analogy to illustrate my strategy. Now, the same principle that I saw on USD CHF is the same principle that I applied here. That I went to the 1-hour time frame, and here is simply the point of interest that I'm assuming price to get to, right? I'm assuming price to get to this point of interest here, and then we'll look for a sell opportunity. In this case here, when price was going to this point of interest, price was giving us reason to buy, swing highs and swing low. If you look at this point here, swing low, swing high, swing low, up onto this point where price induced an equal high, and an equal high simply means what? Liquidity. That means price simply induced an equal high here, and maybe if price gives us a change of character, then we can look for a sell. But in a case where price haven't given us a change of character, we can simply follow price to the point of interest or watch price to go to the point of interest. In this case here, I chose to follow price to go to the point of interest. Hence, the reason why I went to the 15-minute time frame and identify the liquidity point here. That I want price to simply come to this liquidity point here, and tap me in and move to the upside. Now, price came almost close to the liquidity point, but didn't tap me in, and price still went to the upside. This is basically how I backtest. I'm not worried about the outcome, right? I'm focused on identifying the pattern correctly, because it requires consistent practice for you to be able to recognize the pattern effortlessly. Now, why am I not worried about the outcome? Why? Because I understand that if I get one particular pattern correctly, I'm going to make more than I lose if I don't get one correctly. For example, USD CHF. I lost this particular trade here and lost $15. Yes, something like that. If I had made more money, or if I had won this trade, I would have making approximately $47. Right? That's basically it. But now I lost this trade and I'm down minus $15. Now here again, the same thing. I'm risking $10 to simply get $39. That if I simply win this trade, I've recovered twice of what I lost. So I'm not worried about the particular outcome on a particular trade, because I know that if I lose this particular trade, I'm going to win the next one. And that win for the next one is simply going to recover the old loss and give me more wins. So even if I lose two trades, I'm still not worried, because the next win is going to recover the two trades and still give me an extra win. Now, if I lose three trades at a row, if I win one, I simply recover all the losses. My risk to reward is simply a 1:3. Look here closely. You see that it's simply a 1:3. Look here, a 1:3. GPUSD, look here, a 1:4. So I'm focused on the patterns and the risk to reward, because the risk to reward is simply going to help me recover from any loss that I have initially and even give me more. That if I take 5 trades and I lose the first trade, if I win one, I'll recover the 3 trades I lost. If I lose 4 trades, then I'll now be on a drawdown. Do you understand? So it's based on risk to reward and your ability to recognize the patterns, which can be very tedious and difficult. And the way you can do it is by consistent practice. That will be all for this video. I will see you on the next one. Peace.